Hello and welcome to another episode on the Property and Lending Show. Joined as always with me, Fadi and Mark from Powerloans, outside their new office building in Madrid or Central Station or something. How are you, gentlemen?
Good, pretty good. I'm in Europe, so.
Where are you, Mark? You're
London.
London. Powerloans gone global. They're too big for Sydney. Fadi, Mark, we got a big episode today. New RBA rates have come out yesterday, first Tuesday of February, first update of the year. So we'll get into that. We'll find out what it means in terms of retail rates. What does it mean for everyday people? And a few tips on saving money, etc. And I think Fadi wants to have like a 10-minute monologue rant. So we'll get to him a bit later. But before we get into it, Mark's tip of the week is back. And I'm very excited to hear Mark's tip of the week.
I'm actually just opening it up, so give me a sec.
I guess what I wanted to do as well before we start, I thought we'd bring up, someone that's been now been in a book, someone's been named in a book, and bring that up about the free book you're also giving away, been offered in a book as well. So why don't you give us a bit of a 2-minute, 3-minute rundown, and where can we get this book, and can Mark and I get it for free? So
usually I'm the host and I don't get asked questions. Now I know how Mark feels every time I ask him how his week's been.
But that's a crazy achievement. So tell us a bit about it.
Yeah, we have a chapter dedicated in a book called How to Invest in Property, Stories from Successful Property Investors, which is really cool, to be honest. It was a very cool process being part of writing a book. I always wanted to write a book, and then after writing a chapter, I realized I never want to write a book because it was very difficult. I'm not gonna lie. There's a lot of hours, but it's a cool book. There's a lot of really successful property investors that contributed to this book from Australia and around the world. It was published in the UK, so it's not specific to Australia. Well, the principles from these guys across different countries are applicable here as well. So if you go to First Brick's social page, Instagram, LinkedIn, Facebook, whatever, and you go into our bio, there's a link tree there where you can find a link to purchase the book. Otherwise, we are doing a giveaway as well. By the time this podcast is released, actually, that'll be done. But if anyone is after a book, they can just message us and we can sort it out for them. I'll give you a free book, Fadi, and depending on Mark's tip of the week, we'll see if we can figure out 2 free books. Tell us, Mark, what's your tip of the week?
Obviously, with the rates going up so quickly, anyone that has a mortgage has felt the pinch. So obviously, the tip of the week will be about how to sort of minimize your rate for your repayments. If you're an existing mortgage holder, it's no secret that new customers always get the best sort of deals. You get the cashback offer, you get the most competitive rates, and existing customers sometimes get left behind. Some banks are very good at retaining customers, very good. Some banks are atrocious. So every bank has their own sort of way to maximize the discount that your bank will give you to retain you as a customer. So definitely give Fadi or I a call so we can guide you through that. I had a customer call me the other day with one of the big 4. He was on 5.85, told him exactly what team to call, gave him the number, what to say, whatever. They dropped it to 5.19 with one phone call. It's like 0.69 or something with literally just a phone call. Like, I don't know how busy everyone is, but I'm sure you have 5 minutes. That would save you hundreds of dollars a month. And just to give you an idea about how important it is, especially if you're coming off a fixed rate, there's about 23% of Australians are coming off fixed rates this year. I can't remember how many billions of dollars of loans, but it's crazy. So a lot of people will be in this predicament where your fixed rate is going from like 2% to 5%. The increase on your repayments, so if it's a $700K loan, your repayments will increase by $1,170. If it's a 1.4 mil loan, it'll go up by $2,340. So very important to contact us so we can direct you as to how to minimize your rate with your lender. This is not like a full application. You don't actually ever sign anything. A lot of our customers that we have on our books that we reprice, a lot of the time they actually aren't aware until it's done. I had a customer with Macquarie that I repriced them, and they got a text from Macquarie after they got a discount And they called me saying, "Oh, I didn't ask for anything. What is this?" And I'm like, "Oh yeah, I sort of negotiated with them, got you a discount without them even being aware." So our customers always look after, and we sort of make sure they're always on competitive rates. They don't need to sign anything. They don't need to do anything. We do it for them, and it's applied to their account from the next month. So definitely contact us, because your bank will have a very specific process on how to maximize that discount.
Just so,
Awesome.
if I can add something to that as well, something that the banks don't want customers to know either, even if you're with the current lender, and that current lender at the moment has a cashback offer, if you fight them, if you be like, I'm going to move across, send me to your retention team, wherever it may be, in most scenarios, Mark and I have actually had customers that had it, they'll give them some sort of a cashback to stay as well. You're not only just matching the rates, but also getting that cashback.
So I actually got that with my, but obviously like another process with my bank, I did it. They gave me a $2,000 cashback to be retained. I didn't have to sign anything, nothing. And they paid that to me if I stayed with them for another 6 months. So every bank's slightly different. They'll offer you something.
Yeah.
Amazing. I I have a insider source at CBA. I can't say more than that, or else they get in trouble. But they mentioned that this month they have 25,000 loans going from a fixed to a variable, just this month alone. So a lot of people out there that's going to impact. So definitely excellent tip of the week. You surprise me every time.
You get a book now.
You get a book. You get a
Start the process days before you finish. Before your fixed rate expires, 3 months before, give us a call. Because if we end up needing to refinance, because that's more suited to your needs and objectives, and is a better offering for you, it does sort of take time by time we get your documents and meet with you and all that stuff. So better to be prepared.
Beautiful. Okay, let's we'll shift over to the topic of the week and what we're talking about. So the Reserve Bank of Australia, Governor Philip Lowe, yesterday announced that the official interest rate has gone up again to 3.35%, which is the current cash rate target, and the current inflation rate is 7.8% at the moment, so on the up as well. Fadi, what does this mean for banks? What does it mean in terms of retail rates? What does it mean for people with mortgages?
It means it's going to get a little bit more harder before it gets a lot more easier, or at least a lot more better. The upsetting thing about this, and I know, Mark and I and yourself have brought this up probably every single episode, is that during the COVID period, I think a lot of people kind of banked on the promise that the RBA or the banks weren't going to increase rates to a minimum of 2024. But obviously, from what we can see here, they started increasing rates at the end of 2022. Around, I'd say, October, November, we started seeing more increases, more higher increases as well. And unfortunately, people that are pretty much banking that they were hoping to make a higher salary by then, better be put in a better position, probably on investment, probably that rental coming as well. And for rates to actually be a little bit more stabilized, that's what we're going to be finding, where we're kind of running into a wall, because it's pretty upsetting to say, but people that have borrowed or maximized themselves during the COVID period has actually pretty much maxed themselves out and are no longer able to borrow, since 30 to 40% of people's borrowing has actually dropped in that time as well. Now, just to give a rough idea, I think we discussed this the other week as well on the podcast, is that with the buffer rate, we already know that, let's say, Mark or KM can borrow at the 4% or the 5% these days, but we're seeing assessment rates for the buffer rate now going up to above 10% for most banks, which pretty much banks want to know, are you guys able to borrow that amount that you guys are going to take at the 8, 9, or 10%, which is called the assessment rate. Now, the worrying thing is that we're going to have to keep up with every single month the borrowing going down. So I think the biggest advantage is if you are looking now to purchasing a home, or if you are looking to refinance, it really is all about timing now. The sooner you get in, the better, because if you are approved on today's rate, that rate, at least, 3 to 6 months, Mark, that gets to hold on to that rate, the pricing rate, once you submit it,
Yeah,
3 months, or where if you're waiting to submit or waiting for a better time, your borrowing capacity is going down on a monthly basis now.
And actually, about that, not all banks actually even hold your rate of your pre-approval. So with some banks, even if you're approved for, 600 grand or whatever it may be, and if that was your maximum, next month when the rates go up, your borrowing has gone down, even though you're pre-approved. So
Correct.
your bank needs to reassess every single month to make sure. That's why we always put our customers with pre-approvals with banks that will lock in the rate. Because even if the interest rate is 0.1% more, even if they don't have branch act, whatever, even if it's not, the customers are, at the end of the story is it's the best for the customer to be locked in with your rate now while the environment is increasing every month. So we'd always prefer to go to a bank that's going to lock it in. We don't need to worry about it. So that way there's no surprises when you buy a property, especially if there's an auction. That'll be a disaster if your rate's not locked in.
And again, we go back to prior to COVID. Does anyone, let's play a little bit of a guessing game. Anyone know what the rate was? Or you guys will probably know because you had home loans back then. What the average rate was for a fixed rate prior to COVID?
What year was COVID? I don't remember.
2020.
1.5%.
No, prior to COVID, what was the rate?
Well, in 2012 was when it was last 3.5%.
Yep.
And then before that it was 4.5. Last time it was, at its peak at 7 was 08 GFC. So
yeah,
it's not, but it was hovering around the 4.5, 4.75% for a long time since 2010, pretty much to 2012, 13.
Yeah. So that's what we were saying. For example, I was locking customers in for a 3-year fixed rate of 3.75 for an owner-occupied property, which was an unbelievable rate at the time. And you're right, the average interest rate is around the 4.5%, between 4.2 to 4.5%.
That's the bank's rate.
That's the bank's rate.
That's the official rate, sorry, not the bank rate.
Oh, the official rate, yeah. No, that was the bank rate. So that's the rates that customers looking to borrow at, for example. Now, what worries us is that everyone's like, oh, what's the main question that all of us are getting asked these days? Do you reckon there's going to be any more raises? If you ask me, I reckon there is, because if we just learn from history, you just discussed 08, 09, then the 2012. It's going to get a lot worse before it gets better, in my opinion. I still see rates going up or increasing. I was having this conversation with Mark this morning with the RBA coming out yesterday that the rates I seen going up to at least June, July on a monthly basis. We've already seen most lenders actually, put forward the whole 0.25% the RBA is going up with. Usually it's the 0.10, 0.15. But Mark, from most of the emails that we've been getting today, most of them are passing that 0.25%, the full increase. And one lender in particular, obviously we're not going to name any lenders, increased their rate by 0.44. So here's another thing as well that customers need to be aware of. No matter if the RBA increased the rate, whether it's by the 0.25 or by the 0.5 or 0.75, it really comes down to what the bank really feels like that morning. If they've had a great morning, if they've had a bad morning, wherever it may be, they're actually in control of increasing those rates. So when they actually throw back at customers and say, oh, we're only trying to keep up with inflation, or we're trying to only keep up with the RBA cash rate, whatever it may be, no, the bank are actually in control in regards to actually passing those sort of increases across to their customers.
So, yeah, I mean, Governor Philip Lowe in his statement pretty much did say there will be more increases. He did actually just say it, there will be more. The next few months, there's going to be more until inflation starts to come down, which they are expecting from memory in his statement for that to start occurring mid-year and then throughout to 24, 25 to come down to about 3.5%. So right now we're at 7.8, pretty much 8%. So there is definitely more interest rate hikes coming before it goes down. What's interesting though, I mean, I always like to look at it from a housing perspective, and what does it mean in terms of the market, and what does history tell us? And we always tell people, because the number one question I get as a buyer's agent is this the right time to buy? And my answer never changes. My answer is always, the right time to buy is when you can afford it. And we'll get into the money saving and the other side to it. But just really quickly, I thought I'd mention. So when we look at the interest rates from 2010 to 14, interest rates were between 4%, 4.75, and then by 2014, 2.5, and then from 2015 is when it started to drop a little bit. And we look at housing market growth between 2010 and 2014, there was no real growth. It was very stagnant, right? But straight after it, we had a big spike. Same thing happened in 1990 to 97. There was no real growth, and interest rates were quite high. In 1990 to 97, I'll tell you right now what the rates were. They're around the 7.5%. And then straight after, though, there's a big hike. So we always say, this is a good time, especially if you can afford, because the competition is lower. And in saying that, we've been outpriced every week still on properties, and we're getting smashed. And I was with Mark on the weekend when I received a phone call from an agent that on a property that we had a deal in principle on, and then ended up having 12 other offers come through or something like that. So it's still hot in certain areas based off the data, but from history we can see in these graphs, and I might put some of these graphs up on our socials so people can see what we're talking about. These are the times where you should be able to get in and then reap the rewards straight after, because rates are going to go up and down for the rest of your life. And it's really about taking advantage when you can. So I thought I'd just throw that in. But in terms of,
and keep in mind,
what it means,
sorry, on that point, we've also agreed it's always a good, like, for example, if you're able to service a loan on today's market, if you're able to afford that loan at the higher rate, and with the market a little bit lower, like we discussed a couple of weeks ago, once the market again shifts, like history always tells us, the property market goes back up again, the interest rates start to stabilize and come down again, you're in an unbelievable situation where you were able to service that loan at the highest possible rate when the market was down. And you're now moving across to a place where your property is actually going up, you're seeing the capital gain, and your repayments are also going down. So if you're also asking, if we have customers coming in now and asking, is this now a good time? If you can service a loan right now, then it's actually an awesome time to do it right now, because in a couple of years, you'll be laughing. And that's just my opinion.
Yeah. I was talking to a customer. I was at a customer's house the other day, and we were just sort of going back and forth if today's, like, now's the right time or not. He's like, oh, maybe I should wait till the rates go down. Everyone says to wait till the rates go down. And I told him, like, it makes absolutely no sense to make decisions on variable rates that will change over your 30-year loan term like 100 plus times. Make decisions based on the property market at the moment, in terms of, is the market you're looking in, is it like a good time to buy? Well, at the moment it's, everything's sort of declining, which is obviously means it's a good time to buy. And history sort of tells us that it corrects sharply as well. So once you miss the dip, which you inevitably will, if you're waiting to hear an announcement on the news, will sort of be priced out of the market. And I think we all have customers like that. That 2 years ago they came to us, I want to buy property, and then up to now they still haven't bought anything because they're waiting for the dip. The dip came, they're waiting till the bottom, they missed the bottom, it corrected sharply, and now they're like, no, I'll just wait till the next one. And they've missed out 2 years plus on capital growth. So as Kim said, best time to buy is when you can afford it, without putting a lot of stress on your immediate sort of lifestyle.
So I guess we'll go on to, okay, so we make, there's only so much we could talk about interest rates going up. Really, it is kind of what it is, and they're going to continue to go up. And if you got the money, this is a good time to buy. And if you don't, I guess, or if not about if you can't buy, about if you are going from a fixed to a variable. And I guess this is going to tie into what Mark was talking about before in his tip of the week. But what tips are there besides that clients can look at to save money and get through this period of high interest rates?
I think restructuring, like they need to, like customers that have, like even when the rates were very low, if a customer had 50, 75, 100 grand, 200 grand, whatever, it's just sitting there. I know the rates are very low and they're fixed, but why don't we split the loan? Why don't you have an offset? You have 200 grand cash. Why don't you split the loan to have 200 grand variable and have your 200 grand sitting in the offset account so you're not charged any interest? It's not going to save you on your repayments, but it will save you years and years off your loan. It will shave years off your loan. And you can access the funds at any time and, all the other benefits with it. So I think restructuring is a big one. If you are currently fixed, you probably have some sort of redraw facility that you can turn on your loan. There are limits as to how much you can put in there. So definitely be very familiar with those after calling the bank, because if you exceed them, some banks charge a break fee. But yeah, I think restructuring for me would be the one thing.
I think just Fadi. costs or in general, I think during the COVID period, everyone got everyone, including ourselves as well, got a little bit more happy where we just found ourselves with a lot more money in our pockets because I guess so many grants were going out, loan repayments were at an all-time low. People added cars or added more holidays, which is I'm always up for in regards to holidays, not to the cars, not into the cars that much. But I think it's just going back to basics, isn't it? Just cutting back on unnecessary, unnecessary activities or like spending, going out to dinner. I think there was a 1 week where I was newlyweds and we were going out to dinner every night because we just weren't bothered cooking. So I think going shopping, groceries, and I think a good thing to do is actually having a budget in place, like a weekly budget or a monthly budget of this is the amount of money I'm going to be spending on movies, entertainment, going out, taking the kids out, wherever it may be, and sticking to that budget for the time being. And then putting yourself in a position where you're able, if you're looking to either purchase a property, looking to purchase a car, an investment property as well, this is the time to save. This is the time to actually hold back and save as much as you can because we're just seeing monthly repayments going up and they're not going to get any better soon. So I think just in everyday living expenses, try and track back to pre-COVID and try and remember what you were spending. This is something I've done with myself recently is that what was I doing prior to COVID and what has that change come now where I'm actually spending more money than I ever was prior to COVID. And I think that's something that we all need to look at and try and, hold back or try and, save us as much as we can on everything. Groceries, petrol. Like I'm always trying to take the missus's car to save on my petrol, to be honest.
Yeah, you're dining out every day though because you're on the big bucks. So
no, I'm dining out because we can't cook.
You've lost touch with reality and the regular person. So
I'm going to see mum and dad more often now to try and get the food off them. So
okay. Is there anything else really to add to in terms of saving? I mean, obviously budgeting and saving and whatnot, but I think really, what you guys have touched on is pretty much everything there is. What you can do is definitely restructure and refinance your loans. I think that is the number one thing to do, especially if there's a little bit of a cashback, which will get you through a few extra months as well, which is always nice. And then finding what you don't need and spending less to get through these periods. But then remembering if you are looking to invest, that we're making 30-year decisions here. We're not making a 6-month or 3-month decision, and that these interest rates are somewhat actually irrelevant to your strategy. And you actually have to have a strategy. And if you don't have a strategy, then that's step one, is build that strategy. Because once you have a strategy and a plan, the interest rates and everything else is quite irrelevant, really. I don't think there's much else to add, to be honest. Fadi, unless you wanted to add something else and yell at someone about something, go.
Honestly, just the whole, we've discussed this quite a bit, and just to be a little bit more thorough in regards to COVID, what we saw in COVID isn't something that we're never going to see again, in my opinion, in regards to rates going that low. One thing that did bug me, I know we speak to a lot of BDMs on a daily basis and different people inside the banks. And then we had that discussion with him. Like I asked the question, like, how are we doing this to the public? How are we doing this to our customers where, they promised, and I told them not to believe the RBA or to believe any of the banks that nothing's going to change until 2024 in regards to the interest rates going up or not. But why are we in a position right now where we're increasing rates knowing that a lot of the customers are going to start suffering, especially the ones that are coming off the fixed interest rates? It's quite a shock. Like, I don't know how many emails or phone calls Mark and I are getting in the last couple of months saying, oh, wait a minute, our interest rates have increased by $900 by interest repayments have increased by $900 or by $1,600, whatever it may be. It's a bit of a shock to the system. And what we've always tried to do is educate our customers a little bit more in regards to, first things first, banks don't care about us. No matter how good their advertising or marketing is, every single bank is the exact same thing. We're always trying to look or trying to chase that better rate, better monthly repayment, their products and features, whatever our strategy, like you said, may be. Second of all, the RBA don't care about us either. At the end of the day, they're going to increase rates whether we like it or not. And what the bank's argument is that during COVID, apparently the banks weren't making any money. Apparently, when the banks were charging the 1.98 or the 1.75 interest rates, they weren't making any money. And that's why you're seeing every single bank out there taking advantage of passing, whether it's the full RBA increase or a portion of the RBA increase, again, prior to COVID, where RBI was coming out for 0.25% increase or 0.15% increase, banks weren't passing that full amount. Right now, they are taking advantage because most banks, instead of reporting a 10 or $20 billion year profit, they're only reporting a 5 to 7 bill profit, which apparently is not making them money. So I think at the end of the day, we always need to do our kind of research, and having one thing that Tony said on last week's podcast is having the right people around you to have the right advice. Don't take advice from the TV or the media or the RBA. Speak to people around you. Speak to your mortgage broker. Speak to your buyer's agent. Speak to your financial planner. Speak to your accountant. These are the sort of people that you want to keep in the loop so you understand, first of all, if you have a strategy in place, tax benefits, any depreciation that you might get add backs on as well, any of those things as well. And when it comes to what should we be doing now in regards to our interest rates going up, or I guess, how do we try to balance that out? Like Mark said, restructure, get in contact with your mortgage broker. Right now, what Mark and I are doing at Powerloans is that we're doing free health checks for any customer that comes along. And first thing that we're actually doing is trying to negotiate with their current lender, whether it benefits us or not. It doesn't really matter. We just want to try and help those customers out. If our current lender is not willing to come to the table, there are over 40 lenders on our panels that we're able to go to, including a cashback offer that we can try and help them out, which is also going to sweeten that deal. But I guess that's my 5-minute or couple of minute rant at the RBA and banks, where honestly, as a broker, it actually burns me how the behavior and the activities over the last maybe 6 to 7 months from the RBA or the banks, where they've actually promised our customers as well in regards to not increasing anything to 2024. And you're finding people just being left behind. And that's the most upsetting thing about this whole thing, to be honest.
Yeah. I mean, I agree that, the RBA probably should never have promised anything.
Yeah.
And even when they did, I remember on this podcast as well, coming out and saying, not to listen to this promise, because if they need to, they will increase it. I guess to the RBA's defense, they really have no option, to be honest.
They often 3 months prior. And then
well, of course they could. Yeah, yes, they could have started earlier, but nonetheless, whether they started earlier or not, the interest rates were still going to go up. This is the highest inflation's been since 1988. Just looking at a graph now. So, and there are 3 real ways to reduce interest rates, reduce inflation, and the interest rates are the main way to do it. And it happens across the entire world. Every country is going through the same thing. And there are so many external economic factors that are impacting it. Mainly, obviously COVID didn't help, but then the war in Ukraine is making it worse, global supply chains and whatnot. But it seems to be slowing, which is good. But yeah, inflation is a wider issue. So if inflation doesn't come down, then you have a bigger problem than interest rates. So to their defense, I guess there's not so much they can do now. Yeah, they probably should have started earlier, and they probably should have promised anyone anything. But I think that also comes back down to us educating our clients and customers, and them having buffers. What Tony was mentioning as well last week's episode, having buffers in place and not overextending yourself. And if you can borrow 5, and that means 500 grand, it means you have $0 left over. Maybe you shouldn't borrow 500. Maybe you should borrow a little bit less to protect yourself. But
I'm just going to be devil's advocate here, because you had to go in and say in their defense.
Yeah.
Then why, when COVID happened, why bring those rates down? Why bring that buffer rate down when they knew, like KM, we had customers prior to COVID that weren't able to borrow or service the exact same loan they got during COVID. So
because I'll explain because the RBA sets interest rates based off a lot of things, right? The interest rate that they set is not solely on housing, right? We look at it solely from a housing perspective because this is our industry, and where we are, and this is what most people talk about, is because it's what the retail world or what general public and consumers can relate to is housing interest rates. But the official interest rate impacts a lot more than just housing. So when COVID occurred and global supply chains essentially were cut off and nothing was coming into the country, and people were not working or were from home, and there had to be government stimulus. All this extra money needs to come somewhere, and we need to stimulate the economy because we weren't moving. So to stimulate the economy, right? The RBA is always in this. Every reserve bank of every country is always, their job is to try and maintain and balance, right? Is to balance the economy. We don't want to have it too low and we don't want to have it too high. Right now we're too high, and during COVID we were too low. But the problem is economic activity was so low during COVID, and there was, lack of jobs, lack of housing sales, lack of everything, that they needed to stimulate. The way to stimulate it is you tell people, hey, money's cheap, borrow. So what happened? Money was cheap, everyone borrowed, and everyone bought stuff, and it became very expensive, right? And then now inflation is too high, but the inflation has flown past where it was supposed to be. The target was like 2.4%. But the reason as well is not just COVID. If it was just a COVID thing, we would probably already be out of it. The war and supply chain still not opening has pushed this a lot, made it a lot worse. And we're seeing that the war impact has gone everywhere. Every country is kind of copying it. So the bank's job, the Reserve Bank's job is, when they set an interest rate, it's not about housing. Real estate is one aspect of about 200 different criteria points that they look at when they set this interest rate. The reason that we talk about it and we're so affected is obviously because it's our industry, but it's also what people can relate to. Right? Essentially, the idea behind it is during COVID, right? They want businesses to continue to work, and they want businesses to continue to hire, and are more likely to borrow money if it's cheaper as opposed to more expensive, right? So right now we're seeing the interest rates are going up. Less people are likely to borrow money because it's more expensive. So we are trying to slow down the economy and bring prices down by increasing interest rates, so bringing inflation down. What happens in the opposite when there is no activity and we want it to happen? We say, hey, here's money. We're giving out everyone free money. And what does everyone do with that free money? They go and spend it. And then you build economic trade and stuff. And then it comes back up. So it is a difficult task trying to find the middle ground, because it's not just based off our own nation's issues. Unfortunately, it's a global economic, well, I don't want to say the word crisis, but it's a global economic issue that they're trying to sort. And I mean, I think it's tough. I think it's tough to find. I mean, they could have started earlier. We would still be in the same position though.
Whether they started early or not, man, look, I completely understand everything you've pretty much said in regards to the economy, the market, whatever it may be. But it kind of feels like these customers during COVID that were given an exceptional amount. Don't get me wrong, some of the responsibility also goes on the customers, because we also, Mark and I also warned them, and what we saw during auctions, and you saw this more than any of us, KM, is that people had access to funds they've never had access to before. And the full process of going into the auction, and we've heard it from customers before, and that's why we've kind of had to turn down a few customers, say, oh, we're not really comfortable writing this loan for you, is I have to get this house at whatever price I can, even if it means I maximize myself out. And that's what bugs me. It's like the RBA or the bank said, let's give these kids, or these people that come through, young couples that come through, ones that just finished school and they've just started working, whatever it may be, let's give them 2 good years. And then after that 2 years, let's put them in a position where they're not even able to service their current loan.
Yeah,
and no matter
I
what
don't
anyone says to me, that's exactly what's happened. That's exactly what's happened. That's what I'm saying. The banks should put more of a thumb rule saying, you know what? Nah, we need more of a surplus, because what if the rates were to go to what it were prior to COVID? That's what should have been done. If the banks really, and this is what really bugs me about the Royal Commissioner, I mean, here's my rant, is that the Royal Commissioner are taking every single swipe at a broker, but ideally, we've had customers come to brokers and we've told them, sorry, we can't service the loan, but they can walk into the branch the next day and somehow service through the same bank that we told them they can't service from, because they've lowered their living expenses. Second of all, the banks have pretty much said, you can afford this loan, have a happy life, and within 2 years saying, sorry, you can't even afford that loan?
Yeah.
That's upsetting, man.
I definitely agree. I agree with you. I think this is more like an individual bank problem than an RBA problem. To be honest, like I saw a very famous. I've seen a very famous auctioneer. I won't mention his name because he's more famous than me and he might crush me. But he made a post and he was yelling at the RBA and stuff. But really, it's a global, it's a wider economic problem. I mean, the RBA interest rate is not a simple figure to figure out. There are so many points to it, and I don't think the RBA's intention when the interest rates were so low was to stuff people over in 2 years' time. I think when you speak about the Royal Commission, I agree with you, because the responsibility lies on the retail bank, not the RBA. The RBA is there to set is set to set a rate for the country, for the nation, and then there is a retail rate, and then there is retail responsibility from the banks to make sure that the people who are borrowing can actually borrow and service, and that's why you have buffers and whatnot. I don't think the RBA, because it doesn't help the RBA for them doing what they're doing now, and to put people in this situation, it doesn't actually solve a problem. So I don't feel it's the intention. But I agree with you. I think it is definitely, there needs to be some sort of, I mean, that's why you had the Royal Commission, but I think the responsibility lays more with the banks as opposed to the RBA, because the interest rate is somewhat, the official interest rate is, at the end of the day, the bank can charge the official interest rate, right? The banks don't have to make money, right? Obviously they want to, and they will, but the responsibility lies on them. The RBA is saying, here is the official cash rate. You do what you need to do with that, right? And you charge what you want to charge. At the end of the day, it's a private institution. So I think the responsibility lies with the banks more so than the RBA. The RBA is setting a rate that's based off so much data and so many economic issues, as opposed to just housing, which is definitely one of them. But yeah, I mean, definitely. And that's why you guys are so important in your role, is to educate and make sure that this is a smart decision for you today and tomorrow, and not just today.
Okay.
But
I
we can, I
guess, the way you've put it, I can agree with that. Let's put the RBA aside. The banks. So the banks part of the Royal Commission. What's our friend's name that was leading the whole thing against brokers and how brokers are not taking the best interest? I can't remember what his name was.
I don't remember.
Let's not even mention it. But it was like targeting brokers. All right. What I want to see is, where's this responsibility from banks, where they were fully aware that these customers that prior to COVID came and saw them, said they can afford this loan. Maybe the bank should have told them, listen, guys, we can give you this loan today because of the RBA, the cash flow, the buffer rate, whatever it may be. But keep in mind, for the next 2 to 3 years, this is going to completely change. Whether we like it or not, it's not in our control, like you just said. That's where the bank, and I believe the Royal Commission should be doing a lot more job to keep those people more accountable. Because honestly, I've had some funny conversations with customers, and to be honest, I say funny where it's funny to have, but I can completely understand where the customer is coming from. One, they are not held accountable. Okay, if the bank knew I couldn't afford this loan in 2 to 3 years, or we're going to increase this buffer rate or increase the assessment rate in 2 to 3 years, why wasn't I made aware? I'm not talking about people that have gone through brokers. I'm talking about people that have gone directly to Bankstown, And like I said, we've had customers approach Mark and I in regards to living expenses, and we said, no, you can't afford the loan. And they've walked into the branch the next day, and branch managers or branch workers, whatever it may be, will be like, no, that's okay. We'll just lower those living expenses and like that. No compliance, no looking after the best interest duty of the customer, which is what we're actually under, bid, best interest duty of the customer. And that's what frustrates me the most. And I'll leave it at that, because I'm going to get a bit wild up.
Well, we'll leave it at that, because as well, Mark has a meeting in about 5 minutes. So we'll wrap it up. And thank you, everyone, for listening. Stay tuned. Keep listening. And I think we're getting some big numbers. And anyone that's listening to this podcast, I don't think we've ever asked for anything, but I'm going to start asking people to just do one thing. I don't want you guys to like or subscribe or give us a 5-star, but please do if you want to. But I'm going to ask, if you do actually listen and you like it and you're a regular listener, just tell one person, because it makes our lives a bit nicer, and it gives us more ideas and different motivation to keep doing what we're doing. So if everyone that's listening just tells one person, we're going to grow this thing to be really big and help as many people as we can along the way. So that's my ask. That's about it. Thank you, guys, and we'll talk soon.
Thanks, guys.